Action SA has formally notified the ANC's budget negotiating team that it will not support the budget. This is the latest in a string of rejections from various political parties. All have cited the proposed increase in value-added tax as a reason for the dismissal. This comes as the deadline of April the 2nd looms, where the National Assembly is due to meet to consider the 2025 fiscal framework proposals. The two largest unions at PRASA have declared a dispute at the CCMA and are threatening industrial action. That's as Satao and Untu say that the rail operator has refused to formally respond to their demands. The unions want an across-the-board 15% wage hike. That's around 5 times the current inflation rate, which sits at about 3%. Unions are also demanding a 3,000 Rand housing subsidy, a 50 Rand per hour standby allowance, a 10 Rand per hour night shift allowance, a moratorium on retrenchments, and a medical aid subsidy. Satao says that PRASA's claim that it's bankrupt is a lie, and with the entity refusing to negotiate, a strike is the only option. Pepkor is expanding. Africa's largest apparel retailer has inked a deal with Retailability to buy clothing and homeware brands Legit, Swagger, Style and Boardmans. The exact amount of the purchase hasn't been disclosed, but Pepkor says it represents less than 2% of its current market value, and the transaction will be settled in cash. The firm says the businesses are a natural fit for Pepkor, and it's looking forward to integrating them and unlocking benefits from the added scale they will bring. Master Drilling has had a good year. The firm has posted record revenue of $270.8 million. This helped support a 22% rise in headline earnings per share. The group has a stable order book of $322 million and a healthy pipeline of $695 million. A dividend of 65 South African cents has been declared. That's a near 24% increase on the previous year's payout. Remgro has reported a 38.7% rise in headline earnings at the halfway stage of the financial year. That's thanks to improved operational performances from the majority of its investee companies. Those include Rainbow Chicken, RCL Foods, Outsurance and Mediclinic. The group also benefited from lower finance costs due to the redemption of the preference shares and the effects of corporate actions implemented during the previous financial years. An interim dividend of 96 cents per share has been declared. Barloworld says it has delivered commendable results for the 5 months to end February. That's as a robust performance from its business in Mongolia helped soften the blow of a contraction at the group's Southern African and Russian divisions. As a result, revenue during the period fell 4.9%. The industrial conglomerate plans to release a trading statement for the half year as soon as there is some reasonable certainty concerning its results, and the company plans to open its books on the 26th of May. Oceana has recorded a strong operational performance for the first 5 months of its financial year. That's as production volumes of fish meal and fish oil doubled. But despite the lift in output, interim headline earnings per share are forecast to be more than 40% lower. That's due to the normalization of global pricing, which has weighed on the group's US and African fish meal and fish oil segments. Oceana expects to release its half-year results on the 9th of June. Fairvest has raised 400 million Rand in an accelerated book build through the issue of new Fairvest B shares. The real estate investment trust says it will use the funds for various capital allocation opportunities. Subject to JSE approval, the listing and trading of the new shares are expected to commence on the 2nd of April. And more citizens went without work in 2024. The latest quarterly employment statistics show that total employment fell 0.8% during the year. That's largely due to fewer full-time jobs, but those who were employed were paid more. Between December 2023 and December 2024, basic salaries increased 4%, while bonus payments rose 3.2%. In international news, Tesla's European market share declined for another month in February as sales of the all-electric car maker dropped for a second consecutive month, despite rising overall EV registrations on the continent. Let's take a look for more detail.
Tesla's market share in Europe continued to shrink year on year in February. That's what market data showed on Tuesday. It means sales of the all-electric car maker dropped for a second consecutive month, and that was despite rising overall EV registrations on the continent. The European Automobile Manufacturers Association showed Elon Musk's battery electric brand has sold just under 43% fewer cars in Europe so far this year. Tesla held 1.8% of the total market in February, down from 2.8% last year. It sold fewer than 17,000 cars in the EU, Britain and European Free Trade Association countries compared to 28,000 in the same month last year. Tesla currently faces a number of challenges in Europe. The EV maker has a smaller, ageing lineup, while traditional automaker rivals and new Chinese entrants launch often cheaper electric models. CEO Musk has also caused controversy by courting far-right parties in Europe, which has hit Tesla sales. Overall, the data showed battery electric sales in the same markets were up more than a quarter against February last year, even as total car sales fell 3.1%. Volkswagen and Renault sales were up, but Stellantis had a tough time as they dropped 16%. And sales of China's SAIC motor rose by 26% despite the impact of EU tariffs on Chinese-made EVs.
And sticking with electric vehicles, China's Xiaomi raises $5.5 billion in an upsized share sale as the company pushes forward with its ambitious electric vehicle manufacturing plans. Here's more detail in this report.
Xiaomi has raised $5.5 billion in a share sale. The Chinese firm made the announcement Tuesday. The world's third largest smartphone maker is pushing forward with ambitious plans for electric vehicles. Xiaomi said the money raised would be used to fund the acceleration of its business expansion, research and technology development. The firm's share price has surged by nearly 150% over the past 6 months. Investors have grown more excited by its EV manufacturing plans. Xiaomi began manufacturing EVs last year with the launch of the SU7 sedan. It has sold smartphones, household appliances and smart gadgets for most of its 15-year history. It reported an almost 50% jump in fourth quarter revenue last week. The company also raised its target EV deliveries this year to 350,000 and reported $4.4 billion in revenue for its EV business last year. Xiaomi shares were down 5.3% in Hong Kong on Tuesday, with the wider Hang Seng Index off just over 2%.